In 2016, Britain voted to leave the EU. Before that, the scope of the EU single market has long extended into financial services, driven by the development of the single regulation and supervision standard for financial services and increasing harmonization of standards across the EU. Confident in this shared standard, EU states opened up their national markets to other EU states to directly provide financial services, or by making it easier to establish branches of banks and financial services firms for other EU states with relatively few additional authorization requirements. This pan-EU authorization is known as passport. There are 9 different passports that banks and financial services providers rely on in order to provide core banking services. Each of these passports is embedded in a particular EU directive or regulation establishing the basic rules for that activity, such as MiFID or CRD. These passports are not available to third country firms or firms incorporated outside the EU who face significant regulatory barriers to providing cross-border banking and investment services. Once the UK has left the EU and the EEA, it would become a third country. Behind the law's operational rights are established services that EU and UK clients depend on and jobs created to undertake that activity. These services will need to be restructured, reauthorized, and reviewed. This would be disruptive, costly, and time-consuming. The ecosystem of other roles that depend on them will be disrupted too. The UK's viability for servicing the single market will fall, and this will inevitably impact the jobs created in the UK and the services provided from the UK, and the effect can ripple out to the rest of the EU. IFRS 9, the International Financial Reporting Standard for Financial Instruments, was completed in July 2014 and will be mandatory in January 2018. It serves as a final standard which incorporates the requirement of all 3 phases of financial instrument projects, including classification and measurement, impairment, and hedge accounting. It's a massive piece that's highly detailed and prescriptive. In IFRS 9, banks must recognize credit impairment to reflect expected credit losses and hold capital to protect against the unexpected. Under the current incurred loss model, banks only recognize impairment due to objective evidence of a credit loss, principally loan arrears. In 2008, credit impairment provisioning, which should form the first layer of protection against losses, did not rise sharply enough to reflect the true extent of losses that would materialize from the crisis. This led to the lack of vital, timely data for regulators and investors. IFRS 9 introduces a forward-looking view of credit quality, under which banks are required to recognize an impairment provision and a corresponding impairment loss prior to the occurrence of a loss event. This approach can result in an impairment provision even when the probability of loss is low. Setting aside provisions could consume a bank's capital resources. The UK Financial Services or Banking Reform Act of 2013 has an implementation deadline of January 2019. The ring-fencing legislation requires each large UK bank to separate its retail banking activity from the rest of its riskier business, such as investment banking activities, into different legal entities. This aims to protect customers and the day-to-day banking services they rely on from unrelated risks elsewhere in the banking group and shocks affecting the wider financial system. It applies only to UK banks with a 3-year average of more than £25 billion of core deposits. The impact of the 7 aforementioned regulatory and political changes in banking mostly affect reporting and operational infrastructure, compliance spending, risk management, or the capital held against risk. The overall direct effect would be increased expenditure and controls procedure in meeting regulatory requirements and restricted business activities, as the most lucrative services are usually those of highest risk, which are not permissible under conservative risk policies. And strict capital requirements limit the scale of operations for most firms. In summary, the main regulatory and political changes are MiFID, Basel III, Dodd-Frank, IFRS 9, Brexit, and UK banking reform. These changes profoundly affected the banking industry on almost every level.